So Robert Shiller is telling us to not buy homes right now. He's basically saying wait about 6 months because we're going to see some changes. And he's probably the guy that can almost guarantee that we will see some changes. So welcome to Housing Bubble 2.0 News of the Week, or as I like to call it, another episode of As the Housing Market Turns. Randy Patrick here, putting the realism back in real estate. Today is March the 30th. The time is flying by. I have not done a video for a long time. I apologize. There's tons of news going on. I'm going to start just doing one topic videos just because I got to catch up with everybody, and I appreciate everyone's patience. There's a lot of stuff going on. The market's changing. We are busy. A lot of things happening. We'll get into that shortly. This video is brought to you by our friends at foreclosure.com. So if you're looking to find out the distressed properties and take a look at what's happening in your neck of the woods, your backyard, your zip code, go to gethousingdata.com. That's gethousingdata.com. It's my affiliate link. You can check out what's going on right there. It's worth your time and effort. All right. So big news. Tuesday, the last Tuesday of the month is when the Case-Shiller National Home Price Index information is released. Case-Shiller is a tag-along, drag-along calculation of three indices, a 10-city, a 20-city, and a national index on where the housing market values are at. It's usually, as I said, a tag along because even though we're at the end of March, we're talking about January time frame here. So delay your home purchase, Bob Shiller warns as prices slide for the seventh straight month. Very interesting. U.S. home prices, according to the S&P CoreLogic Case-Shiller Index, fell for the seventh straight month, leaving home price index up 2.5% year over year in January. As I said, this data has always lagged. It's the lowest growth since 2019. So things are slowing down. The year-over-year appreciation is becoming smaller and smaller. So who is Robert Shiller? Well, Robert Shiller is the co-creator of the Case-Shiller Home Price Index. And they created this with his partner, I forget the gentleman's first name, last name was Case, who has subsequently passed away since that was created. So Robert Shiller is the only remaining person. Robert Shiller is also a Yale economist. So he tends to be looked at for his input in the economy and things like housing and other sort of areas of the broader economy. People tend to listen to him. This is kind of like the go-to to see where housing values are at, his indices. So one of the things I've always noted about Robert Shiller, and again, I don't know him personally, never spoken with him, but he doesn't say a heck of a lot. And when he does say things, he's not coming right out and telling us what's going on or what's going to happen. But I think when you read between the lines, you can see what he's hinting at. So again, a guy in his position is not going to come out and say housing crash imminent, sell now or do whatever. He's not going to do that because he knows it would cause chaos and spook all the markets. But you have to actually sort of look and read into what he's saying. So just so you know, obviously a lot of things are happening right now. It's interesting because what we're seeing is that a difference in regional areas across the U.S. And as I've always mentioned many times, the housing correction, crash or crisis, whatever happens, is going to be metro-based, regional-based as it kind of implements or happens across the country. So we're seeing that West Coast locations are starting to fall quicker than mid area of the country, Midwest. Some locations in the East Coast are still gaining in home value, but those gains are remarkably less than what they were before. So it's kind of like it's moving from west to east, and that's how it's going to play out, kind of like what happened last housing crisis. Take a look at this chart. You can see where things are dropping. It's a very interesting chart because you can take a look at the post-COVID change, which was the increase, and the post-COVID decline. Post-COVID decline from the peak. We can take a look at San Francisco, Seattle, San Diego, Phoenix, Las Vegas are all seeing double-digit depreciation, which is quite interesting. Denver, Portland, Dallas, LA, Boston, Minneapolis, DC, Detroit, Tampa, Charlotte, Chicago, Cleveland, Atlanta, Miami, and New York are seeing decreases from their post-COVID highs. So that's kind of interesting. If we take it a bit further, we can take a look at I think this is when this slide's going to show when he's speaking. So obviously you can take a look at, he goes in all these interviews, CNBC and other locations or other news outlets to talk. So Finally, the man behind the home index, Yale economist Robert Shiller, told CNBC's Closing Bell, home prices are very, very high by historical standards. Yes, we know that because we know where home values were and where the peak was and where we are today. It's absolutely massive. I would extrapolate the downturn somewhat. It's going to continue. So what he's basically saying is that it is going to continue. And for those people who are putting out the narrative that, oh, housing market's going to shore up and get better just because there was a slight decrease in mortgage rates and buyers came back to the table and, oh, pending sales are up ever so slightly, you know what, that's a short-term blip. That's what it's going to be. And he's basically saying the downturn is going to continue. He knows it, all right? He knows it. Maybe if you have a good chance to delay your purchase, it might be a good time to do it. So what he's telling everybody is, you know what, there's still going to be decreases in value. So if you're looking at purchasing at a lower price point, maybe delaying your purchase would be a prudent thing to do, unless you have to buy, you know, for other reasons right now. It might get a little cheaper after 6 months. All right, so here we are, end of March, running into April. And, you know, if you go April, May, June, July, September, October, so probably the fall, we're going to see a lot cheaper prices, which that's kind of been the prediction that we knew this would play out over the course of the summertime as the year goes on for much lower price points. So again, as I said, he is not going to come out and say the sky is falling. He's not going to come out and say, you know, and cause chaos. But when he speaks, you need to listen. And, you know, again, he's the guy, he's an economist, he's a Yale graduate. I'm assuming that means you're a smart person, all right? And PhD economist from Yale, but he's a co-creator of this index. So, you know, and if you actually look at, and you go, you can like type this in and go to, you know, Case-Shiller, S&P, whatever, you get to where the information is. If you actually take a look at, there's a document, a PDF you can download about how it's calculated. It's pretty intense. So it's not like, hey, they're throwing darts against the board and look at a couple of, you know, stuff, your information you get from Realtor.com or NAR. They do a pretty comprehensive deep dive into where the market's at. So this guy is telling us that we're going to have far more decreases in home value as time goes on. He doesn't like to call things like crashes, but again, this is like the pre-crash call. Things are going to get cheaper in 6 months, a little cheaper. He's not saying, well, what's a little cheaper to him? Well, he went on record before saying 10, 15% would seem reasonable as a decrease. As I said many times, many videos before, he's not going out to say 25, 30, or 40%. But again, that's why I'm bullish on him talking when the market's going to be bearish, all right? So when he speaks, I listen and I just sort of get the affirmation that, yeah, it's headed in that direction. So anything you hear is going to be short-term gains and short-term situations that may be a little bit of relief for buyers, but it's not over the long haul, guys, not over the long haul. So very important. And as we say here, we suspect that is what Powell is hoping for. And by judging by mortgage rates, prices have a long way to fall unless the Fed holds. So the basic graph here shows the green being the 20 city composite index. As you can see, it's heading downward now. And red being bankrate.com U.S. home mortgage 30-year fixed national average rates. We're still looking, at a 6.51 as of the other day. So not like we're seeing 4s or 3s, still over 6.5%. As you know, and who knows what the Fed's going to do? So unless the Fed folds, as the commentary here, we're going to continue to see this downward slide in home values. It's just a matter of how much and how fast it's going to happen. So you got to keep all that in mind. And by the way, folks, if you appreciate the information that I provide and my outlook on things, if you could hit that subscribe button, thank you very much. And if you are a current subscriber or think you are, could you just resubscribe? Again, I've been losing subscribers like you wouldn't believe over the past month or so. So I appreciate that. Thanks very much. Helps me get motivated to put out all this information. So here's the press release from CoreLogic, S&P, Dow Jones, whatever you want to call it, the indices. Basically, the year-over-year reported a 3.8% annual gain in January, down from a 5.6% gain the previous month. Basically, we're seeing everything slowing down. Miami, Tampa, and Atlanta reported the highest year-over-year gains among the 20 cities. And you can take a look at that as time goes on. For sure, I'm going to go to the next slide here, and we'll get a little more detailed. So interesting. I like to show this. This basically is the supporting chart or that shows that, okay, the national index right now, the current, if you go to the top right corner of that little bar chart here, We are now 58.6% price or value increase from the 2006 peak. All right, you can take a look. If you go across the board, there, national, our high level was July 2006. We lost 27.4%, and our trough was February 2012. We have gained 118.4% today from the 2012 trough. So you bought during that time frame, you've more than doubled your money on your property, so good for you. All right. Now, interesting enough here that normally I'm seeing on this press release about the case Shiller from S&P, Dow Jones, CoreLogic, etc. I'm seeing some graphs, like physical graphs, was not included in this press release. So I do find that somewhat, which I'm looking for, somewhat unusual. They've had those graphs in there forever. And I'm just noticing, since the graph is trending down the other way, are they trying to minimize exposure on that? You never know. All right. But they didn't include graphs that shows that downward curve now happening. So to me, that's a little bit suspect. Obviously, we want to know where your market is. Let's go through it right now. Atlanta gaining 8.4% year over year. Boston 4.2, Charlotte 8.1, Chicago 4.8, Cleveland 4.8, Dallas 5.0, Denver 1.0%, Detroit 3.2, Las Vegas 0.4%, Los Angeles 0.9%. They're approaching zero. Miami was our winner at 13.8%, Minneapolis at 1.7%, New York at 5.2%. Phoenix plateaued. Phoenix had no price or value increases for the month of January 2023, which means I would expect Phoenix to have a little bit of a drop next month as well. Go negative. Portland, negative now, 0.5%. San Diego, negative 1.4%. San Francisco, negative year over year, 7.6%. San Francisco, Seattle, negative 5.1%. Tampa, we eked out a 10.5% increase. Washington, 2.4%. Again, going to that kind of sort of graph of the U.S. market, West Coast is starting to fall. West Coast gets hit first. West Coast typically had the greater increase in price, and home values are more exponential. The harder they come, the harder they fall is certainly happening right now in the marketplaces. There's other places like Idaho, Boise, Idaho, other locations across the country that are Austin, Texas, that are feeling the pain as well too, with some significant slides in home value. That's what we get right now with respect to what's happening in the marketplace. So again, interesting enough, but the point I'm trying to make is that, guess what? When certain people speak, we should be listening. And in this case, when Robert Shiller speaks, I'm always ears, because he speaks so infrequently on the housing market. And when he does, usually it's got some impact, or we should be reading into what he's saying, because again, don't buy now. Wait 6 months if you can. The information is showing we're going to continue to decline in this year. Is he calling a crash? No, he won't do that. He's saying it's going to continue to decline, and you might want to wait about 6 months to see where things are at. I personally believe we are going to have a couple, 2 to 3, 4 years of this situation, but we're going to see the decline happen over a shorter period of time than what happened last time through. We were peaking at 2006, and we hit the trough in 2012, about almost 5.5 to 6 years. This time we've peaked in 2022. We're probably going to trough in maybe 2024 and then come out of it. So it's going to be a little more compressed, but the damage is going to be pretty significant. Also, as I always mention, all these price depreciations and declines and stuff are all based on economy, inflation, interest rates, inventory, whatever's going on in those markets. Nobody factors in, you know what I'm going to say, the foreclosures that haven't even hit yet. We're going to have 2 to 3 waves of them. They're starting to manifest now. I look at this every single day. I deal with it every single day. That's why I know what's coming down the pike. All right, guys. So appreciate the time on the video here. So once again, if you love the video, like it. If you could subscribe, please subscribe. Share the video with your family and friends. If you want information about what to do in this market, there's my email. Reach out to me. We'll have a talk. I've got lots of things that's going on. We're working with active buyers down here and working with a lot of investors. We have a lot of things that are happening here. Cool things. I've got training and education if that's something you want to learn to do playing in this distressed market. So reach out to me. And yes, I'm going to get back on the bandwagon of making videos just because, quite frankly, I get tired of it. And I've mentioned before, as far as I'm concerned, what I've been talking about for a couple years is already here, and I'm participating in it. So you should too. Keep it going, and look forward to speaking with you in the next little while. Take care.